Hello. In our last video, we talked about the inflation risk, the Fed rate increase, and the recession risk. And we also recommended three stock last week when everybody else was very bearish and the stock market is crumbling. But now, after the stock price has all the three stock has increased about 20%, we are suggesting to cut it down to half of the original purchase. Here we talk about more reason why we would need to do that. First, let's go to listening the Bank of America like a strategist in Asia Pacific. Let him talk about the problem and the risk.
About your report, don't fight the Fed. Certainly that was the right mantra when the central bank was kind of trying to suppress interest rates. But now that we're seeing bond markets are rallying once again, you see the recession risk building.
Yeah.
Is that mantra still sticking, you think?
Yeah, I try not to fight central banks because I end up losing a lot of money. And in my report, I also said, don't fight the Fed and don't fight the tape. And the tape simply meaning market breadth, which is awful. In other words, a lot of stocks are falling and very few stocks are rising, even given the market action last week. So normally when you have both a hostile central bank, or central banks in this case, and a hostile market tape, it's very difficult to make money. Yes, it's true that our global risk love indicator, our sentiment indicator, is in deep panic. And so when you get to these deep panics, even in a bear market, you can get a nice 5-10% rebound, which is, I think, what's happening. Yeah, I still remain cautious and careful. There are obviously pockets which are looking more interesting than they were, let's say, 6 months ago. But our overall message is one of being cautious and being careful, which is the exact opposite of what I was saying from April 2020 to January of this year. At that time, I was unambiguously massively bullish. Now I'm just careful because we need to survive and get to the other side with enough capital in our pockets to play again.
So how does the second half play out for you then? How durable are the rallies that we're seeing right now?
I don't think they're that durable unless we get this magical decline in inflation and we get really bad data, which essentially changes the mind of the central banks that, well, maybe, or the markets in terms of rate expectations going down. I think that could be that's a low probability outcome. So I think we're in a bad box right now where inflation is sticky, and I think we're reasonably confident that the data flow, the economic data, is going to be quite weak. There's a massive loss of wealth year to date. I think people don't recognize this because it's almost like 60 to 70% of GDP if you combine the losses in bond markets and crypto and in equities. And so I think rich people are feeling not as good as they were in January. I think the average person is seeing his or her real wages decline because of inflation. I think there's too much inventory lying around.
Yeah.
And I think housing markets are obviously going to slow down. So I think the data flow is going to get pretty bad. And I think the analysts are going to scramble to revise their numbers down.
If China reopens, I guess, is that going to be the standout? And in terms of relative value, can you?
Yeah, if China opens, sure, yeah. But that's a very big if. And obviously that's going to be very good for Hong Kong, for China. I think China has become less negative in the sense that policy is easing on the margin. I think they are trying to boost growth, a bit from, I guess, monetary, a bit of fiscal. I think the pressure on the corporate sector is diminishing. And so things are a lot better today than they were, let's say, 6 months ago. And which is why you can see that China is outperforming the U.S. But that's a very rare occurrence.
You mentioned it. It's only about, what, 5%? How often does that actually happen?
So when the U.S. market is falling, which let's assume it is as of now, the last few months, the probability of China actually going up is only 5%. So you've got a 95% chance of not doing well in China when the U.S. is not doing well. Now you can
AJ basically is to say that don't fight the Fed. Fed is tightening, and you don't want to get in the way of the Fed. He basically says that right now it's bear market, and you don't want to take too much risk. Let's listen to another one.
At the moment.
Take a look at your funds, though, whether it's when it comes to Asia, local bonds, or renminbi, fixed income. What do you look for in terms of flows now? Where are you seeing at least the most momentum?
No, we just talk about this overall narrative that we are jungling through the inflation versus recession and the slowdown and everything around it. So under such environment, usually safer assets outperform, at least in the foreseeable future. And there are some assets in fixed income that priced in better in terms of recession risk than others. If you look at Asia as an example, Asia credit actually has better priced in default risk than a lot of other its peers. So that's where, for example, Asian investment grade actually comes quite handy.
Yeah, absolutely, Jenny. And with that in mind, if we look at China, it's the spread between high yield and investment grade is huge. And does that high yield story really reflect uncertainty, a lack of confidence, or you could even argue a collapse of confidence there? And what do authorities need to do to address some of these issues?
You're absolutely right. I think when it comes to China, no matter it's on the macro level or it's on the market, it needs to prioritize, it needs to restore confidence, and it needs to reset predictability. And if you think about the Chinese property market for a second, it is complete collapse of confidence of both the physical market and the capital market, as well as from the developer that leads us to where we are today. And some property market participants are blaming it to the tightening policies on the property, but we always have tightening policies on the property market. So it's less about, what's doing good, what's doing bad. It's about restore the confidence on the entire economy, on the entire market.
So basically, Mrs. Zinn is talk about the collapsing of the confidence in the full spectrum of Chinese property market. That's about 30% of the economy. So relatively, it's much bigger than the percentage of the economy than the house market in United States. So that is a significant risk as well. Let's also come back to the former Bank of England governor, and he won the very unpleasant period.
When you say mistaken ideas?
So I think the mistaken ideas are twofold, really, at present. The first is that people, I think, decided that when the pandemic hit, because output in the economy contracted, the right thing to do was to print a lot more money to stimulate spending, to try and bring demand back up. But that's not what the pandemic was about. The pandemic was about shutting down parts of the economy quite deliberately in order to prevent the spread of the disease. And that meant that if you simply print lots of money at a time when you're producing less, you've got a classic case of too much money chasing too few goods, and the result of that is inflation. And we started to see that last year in 2021. So that was the first, I think, mistaken idea. And it's interesting that it was common to all central banks. They basically felt we must demonstrate that we're here, we must do something. But governments were doing a great deal through, in our case, the furlough scheme, which was very sensible. Other governments had their own schemes. This was a very sensible thing to do, but it didn't need central banks to print lots of extra money on top of all that. That's generated a rise in inflation, followed by the mistake, of course, that now I think have understandably worried about the impact of the Russian invasion of Ukraine on energy and food prices, which is not the responsibility of central banks. So that's pushed inflation up further, but it would have been above target in any event. It will come down next year and the year after. The question is, will it come down to 2% where it's supposed to be? And the argument of central banks essentially is, well, we're saying it will come down to 2%, so everyone will believe us, and so it will come down to 2%. Well, that's a very odd way of thinking about it. I call that the King Canute theory of inflation. You sit there and you command the forces of the economy to bring inflation down to 2%, irrespective of whether you're prepared to raise interest rates enough to achieve that. And I think the test will be, once we see towards the end of next year how far inflation has come down, central banks may need to do quite a lot more in order to ensure that inflation comes down from what looks like being double-digit level. It will come down, but will it come all the way down to 2%? And simply asserting that because the inflation target is 2%, then it will come down to 2% is not really enough. And most central banks have fallen into that trap, I think, of just believing that because they say it'll come down to 2%, we'll all believe it. And we'll set prices, and wage bargainers will all believe that inflation will be 2%.
So, Mr. King is saying that the inflation is not because of accident or because of the mood change. It is because the massive printing of cash of like a United States is 25% from the first 2 years of the pandemic. So the number of money supply increased 25%. The number of good during pandemic produced was decreasing. That causing the pandemic. Even not decreasing, it's going to be 25%. So what he said is that this is not because of the Russia invasion, not because of the oil price, not all of these things. It's because more money is printed. So this problem will not go away until the inflation absorbs the new in supply of the cash. So all the monetary policy, all the Fed, and they are not very good on predicting this, and they are not very wise on this frontier. So basically, what he is suggesting is that the inflation problem will not go away easily. It will stay for some time, and the Fed interest rate will go up to a certain degree, and the economy and the whole world economy is in jeopardy. So that's the picture. That's why last time we will talk about we better sell at least half of the purchase when we did one week ago. So that's the basic suggestion today. Basically trying to reduce the risk to be able to survive during the bear market. All right, thanks for now. Bye. If you like my video, please subscribe and hit the like button. Thanks. Bye now.